Okay, good morning, everyone. Thank you for joining us today for our webinar on making the most of your property investments. We've got today with us, I'm Kirk Vaughan from Knight Slow. I'm a tax director and I head up the tax department. And we've also got here Robert Wicks, who's an assistant manager. Robert gets involved in a lot of sort of property related clients, so it's good to sort of share his knowledge and experience in relation to these matters as well. We're really going to be talking to you today about two separate types of things. So the first half of the course is going to be looking at really tax planning for property investors and looking at different techniques and different methods, if you like, to try and mitigate or minimize the tax liabilities on that property business. The second half is then looking at a number of recent changes that have come in that will affect most landlords. Some of them are tax related, some of them aren't, but they're still things that people need to be aware of. So I think it's worth just spending a bit of time just running through those just to make sure that people are aware of that as well. So like I said, the first bit we're going to be talking about is family tax planning matters for landlords. And it's really going to be looking at two different types of scenarios, really. So one is looking at jointly held property and making sure that the rental profits and things like that are working in your favour. The second part of it will then be looking at possibly for larger property businesses, reviewing the possibility of incorporating the business and what some of the benefits and what some of the drawbacks might be as well of looking to do that. So I'll pass you across now to Robert, who will run through some of the tax benefits or tax implications of owning property jointly.
Thanks, Kirk. Hi, everybody. So we're starting out with property owned jointly. So essentially, there's a default position for beneficial ownership. Then this depends on whether you're a married couple or in a civil partnership, or whether you're unconnected or the family members of a different type, father and son, or siblings, perhaps you're just friends. So if you're an unconnected or an unmarried couple, then the tax implications will be that you will be assessed on the actual split of your rental profit. So this is how the money is received to you individually, to each individual of the two people in the partnership. So that can obviously be controlled quite easily. You probably have different bank accounts. You may have an agent who can split the money between you when they're paying that out. So that's usually quite easy to control. The other half of that is if you are a married couple, it's automatically defaulted to 50-50 as far as HMRC are concerned. So what this means is that, you may end up in a position where one or the other of you may be a higher earner. You may have income in the higher rates tax, and the other partner may not. The other spouse may not. And what you may want to do, of course, is to utilise the rest of that, maybe even personal allowance or basic rate band, by making an election to change the split. Now, this can be done by a declaration of trust, a legal document, which essentially is an agreement between you to say what you'd like that split to be. When you do this, it is important to make sure that you also tell HMRC, because that original declaration of trust alone is not good enough for HMRC for them to know how you want the income to be treated. So there's a form called Income Tax Form 17, which you need to complete and send off to the revenue at the same time as doing that declaration of trust. So the idea, of course, is to work out your ideal split in advance, so that you're aware of how you would like your income to fall. Do watch out, though, if you do choose to do this, there could be some CGT implications, and there could also be stamp duty implications. So you do need to watch out for those, and it's important to make sure that you get some advice before you do that. And obviously, that's what we're here for.
Fantastic, thank you, Robert. So like Robert was just saying, it's beneficial to try and get those rental profits in the lower earner's name, hopefully to reduce the family or the partnership's overall tax liability. So there is some planning that can be done there as well. Just to let you all know, there is a Q&A box at the bottom of your screens, hopefully. So if there are any questions about anything that we're talking about today, please feel free to type in some questions, and then we'll try and cover those off at the end of the webinar. Or if you want to give myself or Robert a call or an email, then our contact details are on the final slide, so feel free to contact us there as well. So the next thing that we was going to run through was the incorporation of a property business. Now, this is really aimed at larger property businesses, and there's a number of reasons for that, namely because there's tax reliefs available to larger businesses. The tax savings and benefits are greater for larger businesses, and it also makes it worthwhile. The compliance costs associated with running a company, there's more benefit for a larger business, which means it's worth incurring those costs as well. So like I say, this is really planning for the larger businesses to try and reduce and mitigate their tax liability. How does it reduce its tax liability? Well, very simply, if you're a higher rate taxpayer, you will be taxed on your rental profits at a rate of 40%. If those profits are taxed in the company, then the profits will be taxed at 19%. So there's quite a significant tax saving there, especially if you're wanting to reinvest the rental profits into the business rather than drawing all of the profits out of the company. You'll also probably be aware that there's been changes over the last 4 or 5 years, which have meant that individual landlords get a restricted tax deduction for finance costs, i.e. mortgage interest. And what that basically means is you might be in a position where individually you're taxed on the rental profits at 40%, excluding the mortgage costs, but then you're getting tax relief on the mortgage interest at 20%. And that can actually create a very significant rate of tax. We've actually seen situations where people are actually in a loss-making position and they're still paying tax on that as well. So those rules can be really quite severe for some landlords. So it's within a company, you're not affected in the same way, and you do get 19% tax relief on the mortgage interest costs, and you pay tax on your profits at 19%. So you kind of get full relief in a company on those costs. Another benefit of using the company is that you're able to control your income level, and you can control that by paying yourself a salary or dividends from the company to make sure that your income level is tax efficient. So that might be getting your income level up to the basic rate band, or utilizing the basic rate bands of tax, so you pay no higher tax. It might be keeping your income below £100,000, so you don't lose your tax-free personal allowance. Whereas individually, you are taxed on those profits. And whilst you've got some scope to affect those profits by the level of repairs and costs you might have, typically there's less scope than there is within a company of controlling the income you're taxed on. The other benefit of a company is that if you've got no other dividend income, you can draw £2,000 of dividends from the company tax-free each year. And if you've got various family members who are shareholders, it may be possible for you to benefit from a number of those £2,000 worth of dividends tax-free allowances. So they're the main benefits of running a property business within a company. Unfortunately, it's not as straightforward as just transferring your business to a company. There are tax implications of making that change. The main ones are capital gains tax and stamp duty land tax. Luckily, there are reliefs that can apply. So, for example, when you transfer your business from a partnership or from an individual to a company, it is possible to claim incorporation relief. This means that any capital gain that you have on the properties when you transfer them is rolled over into the shares you own in the company. Now, without this relief, there could be quite a significant tax liability, because typically we'll find that people with a substantial property business have held those properties for quite a number of years, and the value of that property has gone up quite significantly over the last 10, 15, 20 years or even longer. If we didn't have this relief, then, like I say, there would be a large tax liability, which would make the transfer probably unviable. There are a number of conditions to meet that relief, so obviously they need to be checked in detail, but essentially the main aspect of it is that you need to have a business, not just a passive activity of holding rental properties. The revenues yardstick for a business is something that you are actively involved in for 20 hours per week. So clearly, if you had 2 or 3 properties, it'd be quite difficult to argue that you spend 20 hours per week managing those properties. Whereas if you've got a lot more properties, then, you know, arguably there is that amount of time dealing with tenant queries, repairs and insurance renewals and replacing tenants and whatever else it might be. The second main tax implication is stamp duty and land tax. As with capital gains tax, when you transfer properties into a company, it's treated for tax purposes as though they are sold at market value. Now, clearly, if you've got a big portfolio and you're transferring that whole value to a company, that's going to attract a very large stamp duty cost, especially because it's going to include the 3% additional rate as well. Luckily, there is another relief that you can use to mitigate that tax liability. This relief applies for partnerships that are transferring their business to a company, and broadly will apply as long as you've got the same ownership before and after. So you've got the same partners and owners in the partnership as the owners of the company afterwards. The final tax implication is that if a company has got a property which is worth more than £500,000 in it, then it does fall into the annual tax on envelope dwellings tax regime, or which I will shorten to ATED. Effectively, this is an annual stamp duty charge which is applied against properties worth more than £500,000 in a company. Most businesses won't have to pay any tax, because if it's a genuine rental business and the property is let out on commercial terms, there is a relief that applies. So it is just a case that you will need to complete, or we can on your behalf, complete an annual declaration just to claim that relief. But it's just something that needs to be picked up to avoid there being any tax charges. Like I say, there are some downsides to running a company. So, you know, the main downsides are that typically borrowing costs are higher in a company compared to personal ownership. It's obviously quite a topical subject, I suppose, at the minute, interest rates, with the market being how it is. I wouldn't even try and guess what the current rates are. I did know a few weeks ago, but I think everything's sort of changed since then. But it's certainly worth bearing in mind that borrowing costs will likely be higher in a company than they are personally. Although in saying that, because there's a lot of investors that are looking to transfer their business into a company, the market is getting more geared up for this market, and that's creating a bit more of a competitive edge as well. So we are seeing the gap decrease, but yeah, like I say, mortgage costs will be higher. Like I mentioned earlier, the reliefs will only apply to larger portfolios, so it's only really the larger property business that this planning really works for. And the other disadvantage is that there are additional administrative costs of operating a company. So, for example, you need to file statutory accounts, complete a confirmation statement, you've got to do a corporation tax return. But, you know, even bearing that in mind, typically it is still worthwhile transferring your business into a company. But in saying that, it's one of those things that every case has to be reviewed on its own merits, just to make sure that it's the right thing for that business. It's not kind of blanket, this is the right thing to do for all businesses. It's something that has to be reviewed on a case-by-case basis. Just to put this into context, I've tried to pull together a little example. So I've got an individual here who receives £37,700 worth of pension income, which happens to be the basic rate band. So that is a little bit of a manufactured figure. There's also a rental portfolio, a decent sized rental portfolio. Look, we've got £200,000 worth of gross rents, £50,000 worth of rental expenses. So that might include things like repairs, insurance, other bits and pieces like that. There's also £50,000 worth of mortgage interest costs. So we've got a profit of £100,000 being the £200,000 rent, less £50,000 worth of costs and £50,000 worth of mortgage interest. So what I've done here is I'm just sort of comparing here. So I've got the personal column down here, just to understand what the tax cost of that is. So obviously everything is owned by the individual. So there will be income tax payable on the rental income and the pension income. And we can see that the taxable income is £187,700. That is the £150,000 worth of rental income. You'll see that we don't get tax relief at this point for the mortgage interest. The tax on that £187,000 is just under £70,000, so £69,425. We then get 20% deduction on the mortgage interest costs, which is £10,000, giving us a total tax cost of £59,425. Comparing that to someone who's transferred their property business to a company, we've actually got the pension income of £37,700, which is still taxable on the individual, and the tax on that income is £5,026. The company is then taxed on the rental income, which is £200,000 of rental income, the same £50,000 worth of costs. I have increased mortgage interest costs to £65,000. And again, that's to reflect the fact that within a company, there probably will be higher interest costs. So we've got taxable profits of £85,000, which means there's a corporation tax cost of £16,150. The total tax cost there is £21,000. So you can see there's a difference of about, well, just under £40,000 in terms of the total tax cost. Obviously, there is also the £15,000 additional mortgage interest costs. So there is a net benefit here of about £25,000 per year for this client by incorporating their rental business. Now, this assumes that this client wants to invest all of their profits in the rental business and retain it in the business, possibly to buy new properties, possibly to reduce borrowings. It is also possible to draw down some of those profits from the company. And like I said earlier, that can be controlled by paying a salary or dividends of their choice, but there would be an additional tax cost there. So this is a scenario. And like I said before, we kind of need to review everyone else's scenario on a case-by-case basis just to make sure that the numbers do all work. So a couple of tax planning ideas there for you to take away. Like I said at the beginning, we also want to just run through some other changes that have happened recently that will impact all or most property investors. And there's quite a few different changes for you to be aware of. So just running through a few of these now. Robert, do you want to run through the Let Property campaign and the revenues approach to these at the minute?
Sure, indeed. So the HMRC have identified that there's a significant amount of property income that's not being declared every year. And in fact, there's a couple of stats here about some of the areas of the country where this is happening. And actually London and the South East is actually quite prevalent for this, evidently. And so what they've done to try and assist people to come forward is they've developed the Let Property campaign. So the Let Property campaign essentially is a methodology of declaring your income that you should have declared previously, but for whatever reason did not. And by doing it via this method, it will mitigate your penalties. And they're trying to essentially encourage people to come forward based on that. So everybody needs to consider, do they have rental income that they've not yet declared? If that's the case, then pretty much anybody can come forward for the campaign. Anybody who just has a single rental or multiple rentals. Some people may have holiday lets, rent a room. Some people might be renting a room and not really considering whether or not they're breaching the threshold. They might rent multiple rooms. So the scheme is open to pretty much everyone. Therefore, what do you need to do in order to take part? Well, it's an online process. So you have to inform the revenue online that you'd like to take part. And And what they'll do is they'll give you a reference number in return. And then there's an online account that you can use to provide all of the relevant information that you need. So you need to provide information on your personal circumstances, your income, any gains you've got, tax that you did owe and already paid, and then anything that you haven't told them about yet and the impact that that's had on your personal situation. Once you've done that, you can then make them a formal offer to say, this is how much I haven't declared and this is how much we believe that we therefore owe you. The revenue will come back to you. Hopefully, you know, they'll look at the numbers. If they have any queries, they'll ask for more information. If not, they'll accept your offer and they'll give you a settlement figure, which would include penalties and interest. So as far as penalties are concerned, by coming forward and using the Let Property campaign, you're mitigating the amount of penalties owed versus if the revenue targeted you and found out that you had not declared this income without you coming forward. So essentially, it's beneficial to do this now, you know, to let them know, as that will mitigate, because the penalties for not declaring the income can be quite substantial, whereas what they'll do is they'll look at your individual circumstances. Why was this not done? How quickly did you come forward? All of those kind of things can help, but your penalty would be based on an individual circumstance. They then would charge interest as well, because unfortunately interest is pretty much unavoidable. They'll charge your interest from the date in which your tax should have been paid all the way up until the date that you did pay it, and that should all be included in their settlement figure to you. Obviously, yeah, there's a piece here about interest rates having increased. Again, we've already covered that. So HMRC have changed their interest rates accordingly. So even more reason to get onto that as quickly as you can.
Yeah, thank you for that, Robert. So I think it's important to realise as well that the revenue do have all of this information. They do have their computer system that pulls information from the land registry, from banks, from mortgage providers, and a whole raft of different, you know, sources that they get information from. So the revenue do know who has got rental income and not declaring it. It's just that there's the backlog of working through it. So like Robert said a little while ago, it makes sense to make that declaration now. If you or someone else have got undeclared rental income, I do feel it's a matter of time before that will be corrected, and it's beneficial to make the first move just to improve that penalty position as well. So the next change that's impending or in progress is the new costly energy efficient rules. Basically, from 2026, landlords have to make sure that their new let properties achieve a band C, or at least a band C, on their energy performance certificates. Existing buy-to-lets have got until 2028, so it's only new properties that have got to make sure they meet this condition by 2026. Existing properties have got until 2028. This, for some older properties, could be quite a significant cost, and the government and the revenue appreciate that. There is a consultation to try and cap the cost of upgrading your property to meet these new energy performance levels. The cost is going to be £10,000 that they're proposing is going to be the cap on it. But again, even if you've got, well, it doesn't matter how many properties you've got, that is still quite a significant cost for some. If you've got 2 properties or 10 properties that have got to meet these conditions and you've got to spend £10,000 on each property, like I say, for 10 properties, that's £100,000, and that is quite significant. So that's something that I think needs to, well, people need to be aware of and probably plan towards as well. Most of the changes to properties or improvements to properties to meet that condition, if not all of them, are going to be deductible from the rents received. So I think there's 2 issues here. There's the cash flow issue and making sure this expenditure is forecasted over the next few years to make sure that it can be afforded. And secondly, it's making sure that those costs are incurred any year that you want them to be incurred to try and control the profit level of your business as well. So it's just worth giving that a little bit of thought. It is still a bit unknown as to exactly how this will come in and when it will come in. At the moment, we've got no confirmation of funding or exemptions on this, so it does appear as though it's going to apply to all. But like I say, this is a bit of a developing area, so it's just something to be aware of. Something else certain landlords need to be aware of is local licensing schemes. So these are run by local councils, and it's not something that I'm going to cover in great depth in this course today, but they can apply to different people. They require landlords to register with the local council, meet different conditions and things like that. They vary from council to council, which is why it's hard to sort of give a summary of here is what the conditions are and who they apply to and whatever else it might be. But what we have got is we have got a map here of the licensing schemes in London on the left, and also other licensing schemes across England. You can actually see around Suffolk, there aren't actually any of these schemes, which is where we're based, but clearly there are a lot around the UK, like I say, a lot in London. And we have got clients that are impacted by these as they have rental properties outside of, potentially in London or other areas. But it's just worth bearing that in mind, especially if you're buying or acquiring a new investment property. It's something to be aware of and look into to see whether you do have to comply with any of these schemes before you make that investment.
So we just wanted to talk about a few of the other new tax rules that are affecting purchasing and holding of property. So holding property, certainly for investment, has been targeted for quite some time now by the government, and it looks like there's no let up. Essentially, they're changing the rules all the time, and it's quite difficult to keep up with those for you landlords. So here's a couple of things that have changed relatively recently. New CGT deadlines. This is essentially referring to the 30-day, now 60-day UK residential property return, which I'll go on about in a moment. Changes to mixed property and multiple dwellings relief, which Kirk is going to cover. And then we just wanted to mention, obviously, the stamp duty land tax bans have changed in last week's mini budget. So the nil rate band has been extended from 125,000 to 250,000, which means that most people save sort of £2,500 on a property above that value. The other rates have remained the same: 5%, 925k, 10%, 1.5 million, and properties more than 1.5 million, and eye-watering 12%. So we just wanted to mention that because that's going to be relevant to any decisions that you make based on what we've said today, or any new properties that you add to your portfolios. So capital gains. So this is all to do with the 60-day CGT return, which is for UK residential property disposal. So anybody who has a UK residential property that isn't covered by your principal private residence relief, it's not where you live, it's an investment property, has to report that gain within 60 days. UK residents, if they haven't made a gain, don't have to report it. So there's a little bit of relief there, but you do have to work out whether you've made a gain in order to know whether or not you need to make that return. Which can, if you do then make a gain, you then have to estimate your income, which can be quite tricky if you sell your property at the beginning of the tax year, not knowing what's going to happen for the rest of the tax year. So it is worth knowing that that you do need to estimate your income as accurately as you can, and then generally what will happen is when the tax year ends and you do your self-assessment tax return, any difference in the CGT will be cleared up at that time. They have fortunately extended from 30 days to 60 days, and I think that's only fair. 30 days was a bit tight, but now fortunately 60 days does seem a bit more reasonable to dig out some of those records, especially if you've owned property for quite some time. So who has to pay capital gains tax? As I've said, anyone who's selling a UK residential property who isn't, for whom it isn't their main residence. So it doesn't have to be an investment property. It could be your second home. You may have a second home somewhere else in the country. that you don't live in all of the time, and that's not your private residence. So it's important to consider whether or not you have a CGT reporting obligation for that as well. Homes with significant grounds or gardens can be considered to be partially investments as well. So it is worth considering that if you have a personal home that has significant grounds. I said before that any UK residents who haven't made a taxable gain don't have to do this return on that particular disposal of the property. If you're a non-UK resident, you don't have a choice, you have to do it. And it's an online system, another online system, which is quite difficult to navigate. Essentially, the taxpayer has to set up a specific UK tax on residential property account as part of their personal tax account. And then usually, if we were to do it on your behalf, we would then need to get your account details and ask for authority. And then your return is submitted through the online account and you can pay through the online account. So it's all pretty much live as you go through. If for whatever reason you're not comfortable doing it online or you're not able to do it online, then there is a paper form that could be requested. So it's a bit of a get out of jail free card, but it's certainly quicker, easier, and better for everyone if you can do it online. But it's not exclusive. Anyone who can't do it online can use the paper form.
Also, some proposed changes for stamp duty land tax. So this one relates to mixed properties. And by mixed properties, I mean something that has both residential and non-residential elements to it. Typically, this will either be where you've got a shop with a flat above the shop, or also sometimes landed estates where you might have a house with some farmland or some offices or something like that, which is also on the same purchase land, if you like. So the way that stamp duty land tax rules apply to this at the minute is that if you've got a transaction with both residential and non-residential elements to it, then it's possible to use the non-residential rates for the whole purchase. Now, that can sometimes be beneficial, especially if this is an expensive purchase, because the top rate for non-residential rates is 5%. The top rate for residential is 12%, plus an additional 3% if it's caught by the additional rates. So you could be paying stamp duty at 5% on the top slice rather than 15%. The revenue, I think, are looking into this because they feel these rules are probably being abused a little bit. And you might, for example, have a house which is worth £1 million, and then you might have £50,000 worth of commercial property, and the whole proceeds at the minute, the £1,050,000, is being taxed at the non-residential rates, which the maximum rate is 5%, like I just said. The revenue is saying, well, I don't think that's right. What we should be doing is actually apportioning it, and it should be a case that the residential rates apply to the £1 million for the property, the home, and then the non-residential rates can apply to the £50,000 non-residential property. So these have been looked into the revenue, I think, just because it doesn't feel fair. They're looking to level the playing field, as they say. So it's just probably just one to watch if you are buying a mixed property with residential and non-residential elements to it, because the stamp duty land tax cost might increase in the future. Also, something else that they're looking to change for stamp duty land tax is multiple dwellings relief. The way this works is if you're buying a number of properties at the same time, rather than paying, and this is residential properties, rather than paying stamp duty land tax on the total amount, so if you buy 4 properties at £200,000, rather than paying stamp duty land tax on the £800,000, you pay stamp duty land tax on the average price, work out the stamp duty on that, and then multiply that by 4, being the number of properties. Now, that often comes back with a much lower stamp duty land tax cost because you're able to benefit from the lower rates of stamp duty multiple times based on how many properties you're purchasing. But again, the revenue are feeling in certain situations these rules are being abused, and they're looking to possibly target these rules a little bit better, and stop people trying to benefit from these rules. So we don't know the full details of this, but it's again something that is being developed at the minute, and we're just keeping an eye on.
So there's new rules regarding registration of overseas entities as well. Now, this is registration of overseas entities who own UK land or property. So what HMRC and the government more widely are trying to do here is to identify who owns the land or property within the UK. Now, if it's owned by an individual, the land registry will have the information for the individual. If it's owned by a UK registered company, with England and Wales, Companies House, that company would then have a persons of significant control register, which would tell you who owned the company. If the company is actually based overseas, at the moment, there is no mechanism to know who owns the overseas company and therefore who owns the land. So what HMRC are doing is they're implementing a new register, which anyone who has a company registered overseas will have to abide by. And these rules have come in already, 1st of August 2022, for anyone who wants to buy or sell land within a foreign entity. If you have a foreign company and you already own property and it hasn't transferred hands yet or will in the future, then you need to register by the 31st of January 2023. So this is essentially to ensure that there's accountability for who owns what land, so that can be maintained. And so who needs to report? Anyone who has significant influence or control over the entity, 25% or more ownership or voting rights. So it's broadly similar to the persons of significant control rules, but obviously those wouldn't be relevant. They wouldn't be they don't catch foreign entities. So this has been put in purely for foreign entities that own property. So there's also an annual update to make. So it is something that you do need to have on your radar. And once you've done it once, you need to make sure you continue to do it, because it's something that they will no doubt check on, a bit like your annual return at Companies House, or confirmation statements is now called. So they're hitting this fairly hard. If you don't do it, there's a daily fine of up to £2,500, which seems quite harsh, but they obviously want to make sure that this is registered as quickly as possible. They're also threatening imprisonment. So this is something that you want to be doing if that's you, or if you're someone who you know who has a foreign company who owns UK property. It's well worth letting them know about this. I don't think it's been particularly well publicised myself, so it is something that really it's well worth knowing about.
Fantastic, thank you for that, Robert. So that does bring to an end our presentation on various property aspects there, tax and non-tax related. Like I said, halfway through the webinar, if you've got any questions, obviously feel free to put them in the Q&A box. And I'm just having a look now just to see whether we've got any questions coming in. I've got one here. If a 60-day capital gains tax return is completed, do I still need to complete an end of year self-assessment tax return? Robert, do you want to clear that one up?
Yes, yeah. As I said before, if you would normally do a tax return, and usually if you have an investment property, you've probably got property income, so you're already doing a tax return, then yes, you would want to do that on your self-assessment tax return, and that closes the loop between doing the original submission and doing your final year. Here's everything that's now actually happened, a return. If for whatever reason you don't do a self-assessment tax return, you have no reason to do so. So particularly, as we mentioned, if you sold a second home, you may have never rented it out, you may not have any rental income, all of your income may be taxed at source. You don't have to register specifically for that, but what you do have to do is ensure that the estimate of income you used is correct or appropriate, so that the amount of CGT you paid was correct, because the CGT bands are determined on your income level. So your income level would be X, and your capital gain would go on top of that. If that breaches the higher rate tax band, then that chunk of the gain will be taxed at the higher rate for residential property, which is 28%, as opposed to the basic rate band percentage, which is 18%. So you do have to make sure, even if you don't do the self-assessment tax return, you don't have to, you still need to make sure that the return was accurate, and you can actually log back into your account and amend the return for an updated estimated income figure if that was wrong or it affected the amount of CGT you needed to pay.
Fantastic, thank you. And got another one here. How many properties do you need to have to make it worthwhile incorporating a rental business? Like I said earlier, there's not really a number of properties. It has to be a business. So it's the number of hours, like I said, which you're spending on that property business, the amount of activity you spend in the business, which is more important. Typically, I think it's going to be difficult to incorporate if you've got under 10 properties. But it does depend as well on the nature of the properties you've got. If you've got HMOs, for example, so homes with multiple occupancy, typically there's more involved there because you'll have 3 or 4 tenants per property. Whereas if you've got, you know, a normal buy-to-let, if I can call it that, where you've got 1 tenant, it's managed by a managing agency, then I guess there's less involvement required in that business, and it's going to be more difficult to try and justify that it's a business that qualifies for the relief to transfer it to a company. Okay, so thank you very much. That concludes our webinar today. I've got a slide there, like I said at the beginning. If anyone's got any questions about anything we discussed today or any other matters, then feel free to contact myself or Robert, or your existing Nightslow contact. Our email addresses and telephone numbers are there. Thank you very much for your time, and we'll speak to you all soon. Thanks.